On today's Home Buyer channel, I want to talk about buying down points. Is it worth it? Hey, welcome back. Enrique here with First West Financial. I'm a mortgage broker located in sunny Southern California, and I come to talk to you about all things related to buying a home, especially if you are a first-time buyer or if it's been a while since you bought a home. You are in the right place. I have tons of videos that talk about this. Today, we're going to talk about points. I'll explain what it is, and then I will tell you later in the video if it's worth buying points down or not. So let's start with the basics. What does it mean when a lender tells you that you are going to be charged points or that you are going to buy down points? Well, let's explain it. When you purchase a mortgage, when you purchase a home and you're going to get a mortgage, the bank is going to offer you an interest rate. And of course, the bank is going to make the investor, the bank, whoever has the note, is going to make money off that interest rate over a long period of time. Of course, the higher the interest rate, the more money they make. The lower the interest rate, the less money they make. So it is in the bank's best interest not to lower the rate, right? Because if they lower the rate, they're going to make less money. But they also have to offer competitive rates. Now, currently, and we are in the middle of summer 2022, rates are a little bit on the higher side than normal, right? We've seen rates as low as 2.5%, 3.5%. Right now, middle of summer, we're in the mid 5% range. So a lot of lenders are offering buying down the rate to offer a more attractive interest to the buyer. So what they say is, hey, instead of giving you a 5.5%, I can give you a 4.5% if you're willing to pay points, which is called buying down the rate. If you're willing to pay a point or two, you can buy down the rate. So what is a point? A point represents 1% of the loan amount. So if you're borrowing $400,000, 1 point equals $4,000. If you're buying $300,000, 1 point equals $3,000, 1%. So does it make sense to buy down the point? So the first thing you need to understand is that that point would have to be paid at closing. So it's going to be part of your closing costs. So it's money that you actually have to bring to the table. So if your closing costs were going to be around $7,000 with that point, and you're borrowing $300,000, now you're going to have to pay $10,000 in closing costs. So is it worth it? Does it save enough money when you buy down the point? Well, there's a few things to consider. First of all, you need to understand that you are never required to buy down the points. If you are working with a lender that tells you that the only way that they can do the loan is by charging you points up front, you need to get a second opinion. Now, there's a small possibility that he could be right, but in most cases, that's not the case. He's just trying to get you a lower rate so you don't go shopping on him. Because if he has high rates, and there's some lenders that have high rates, they know they're going to have to lower it, and the only way they can lower it is by charging you points. There's also cases where you're going to be looking at the estimate, and he's not going to tell you that he's charging you points. He's going to put it in the estimate and hope that you either see it or don't see it. So that's common too. So you have to ask, hey, what is this? If you see anything that has buy down points, interest rate buy down, origination charge, those are the questions you have to ask. Why are you charging me this? And then he's going to say, oh, well, I'm trying to get you a better rate. Well, you need to ask me first if I want a better rate in exchange for buying down points. So let me back up a little bit. So here you are, you're offered a rate, and you are being told that you have the option of buying down by 1%. So what you have to determine is what is the difference in payment between one rate and the other. So let's use an example. Let's say that the rate is 5.5 with the buy down, 6% without. So you have to find out what the payment is for both and figure out the difference. Let's say the difference is $100. Well, if he's asking you to pay $3,000 to save $100 per month, you have to divide it. You have to divide the $3,000 by 100 and figure out how many months it's going to take to make up that money. The other day I looked at an estimate, and it was going to take the customer almost 7 years to make up that money. So I asked him, I said, how long are you going to live in the house? And he says, well, I'm only going to be in the house 3 to 4 years because we're going to move to Arizona. So, well, why would you want to buy down the point that is going to take 7 years to break even when you're going to move out? So in this case, it did not make any sense. He was better off paying the higher interest rate than paying the money up front. Because with points, the bank is still going to make the money either way. They're just going to get it up front. So do not be swept away thinking that you're going to save money because you're getting a better rate. That can be the case in some cases, but not always. So every case is different. Your loan officer should be able to articulate to you what the break-even point is, and they should be able to recommend to you whether you should or should not buy the points based on your circumstances. If your loan officer is giving you a rate and that's all they're telling you, and they said, hey, this is going to cost you $4,000 in points, and doesn't tell you why or doesn't explain it, you're talking to the wrong person. Any loan officer that is worth their license should be able to take time to walk you through that process. In fact, when you get a mortgage with me, I'm very clear. I say, hey, look, I can give you a rate with point and without. And then that way we can, and then usually the question comes around, what's the difference? How do I know what's better for me? And then I say, I'm glad you asked. Let me walk you through it. This is what you're going to save. This is how it's going to take to break even. And this is how you proceed. So education is what is going to make you a winner in this circumstance. So to recap, a point is not a bad thing, but only you can determine with your loan officer whether it's worth it for you or not. If you're saving money and the payback is sooner than you're going to sell the house, then it makes sense, right? So I have people that say, hey, I only want to refinance for 15 years. I'm going to buy it down because in 15 years I'm going to be done. I'm not planning on moving. This is going to be my forever home. Then it makes sense, right? But if you're going to move out in 2 years because you're going to have kids and the house is going to be obsolete, then it might not make sense. Everyone's different. So I hope this information was useful. I know that I opened up a can of worms. If you want to have a further conversation, reach out to me or reach out to your local loan officer and ask them. You can also comment below, and don't forget to hit subscribe. Don't forget to go out and check out my other videos. I have dozens and dozens of videos where I talk about buying a house and everything that has to do with it. I have 15 years as experience as a loan officer, and I want to put that to work for you, and I hope this information was useful. Have a great day. We'll see you again soon.